This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now, back in chapter 14, when dealing with CGT for individuals, we saw, based on how big that chapter was, the various and many reliefs available to individuals. Thankfully, this chapter is a whole lot shorter, because the only one of the reliefs available so far as corporations are concerned in corporate tax is rollover relief. It would therefore be a good idea, if you haven't already done this, to go back to chapter 14 and look at the note that you had there on rollover relief and ensure that the basics of rollover so far as individuals are concerned is a relief that you understand. Because if you do, the only new thing coming in here is indexation allowance. Everything else is exactly the same. What we're going to do is to calculate a gain on the disposal of a qualifying business asset, almost certainly a property used in the trade of the company. And in calculating that gain, we have to apply and we have to deduct indexation allowance. But having got that gain, it is then a question of whether or not it may be deferred. Because what will we have done? Having disposed of one qualifying business asset, as I say, almost inevitably a property used in the trade, we will have replaced it with another qualifying business asset, another property to be used in the trade. That, therefore, is the basis of rollover. The main issue being, if you reinvest all of the proceeds of the sale in the new acquisition cost of your replacement property, then on that basis the entire gain is available for deferral through a rollover relief claim. If you fail to reinvest all of the proceeds, then it's not full rollover, it is partial rollover. And to the extent that proceeds have not been reinvested, so the amount of the proceeds that you've taken out on the deal that you have failed to reinvest in the new asset, to that extent, that amount of the gain will still be chargeable on here the company. The bit of the gain will still be chargeable. Only the balance will be eligible for rollover. So again, as the only new element is indexation, if you know how to deal with individuals and rollover relief, then you can deal with companies, because all it means is that the gain is lower as a result of indexation allowance. But the principles are exactly the same. So if you haven't looked at it recently, I would recommend that you go back and have a look now at the chapter 14 section on rollover relief. It also, as well as dealing with the principal form of rollover, full rollover or partial rollover, also goes on to talk about depreciating assets, assets with a life of not more than 60 years, and what happens when the reinvestment is in such an asset. There, although it's still called rollover relief, we can't actually roll it over. What we can do is still defer it, but to the earlier of three events. So go back, revise chapter 14, unless you have done so, which I hope you have, quite recently there in readiness for this particular section. Okay. If you have done that revision, then let us continue with chapter 21. As we said, the only relief available now in corporate tax is rollover relief. All the other reliefs that you saw back in chapter 14 are relevant only to individuals. Now we talk about rollover. A gain may be deferred here through rollover, where it arises on the disposal of a qualifying business asset. Now, the qualifying business asset that we will inevitably see, land and buildings, i.e. property used in the trade. Both the old and new assets must be used in the business. There must be trading assets used within that trade. Inevitably land and buildings. Now, we do mention here fixed plant and machinery, but that, again, if you've done the revision I've asked you to do, you will recall is your main example of a depreciating asset. The term depreciating asset there, one with a life of no more than 60 years, which, as I mentioned a moment ago, will still allow a deferral of the gain arising, but it is a different type of deferral, whereby the gain is deferred until the earlier of three events, and I'll remind you of those in a few minutes' time. So the main one is the company sells off a property used in its trade and replaces it with another asset, another qualifying business asset, another property. The only question is whether or not we have reinvested all the proceeds from sale, in which case full rollover, a full deferral of the entire gain, or whether we have got partial rollover because a part of the proceeds we have failed to reinvest, we have kept that money for ourselves. And if we have, there is no reason why that part of the gain should be sheltered, and therefore rollover will not be available for it. All right, the way it works. The gain is not taxed immediately, but is postponed until the company makes a disposal of the replacement asset without any further replacement. Again, if you keep on selling and buying, reinvesting all of your proceeds every time that occurs, then that gain or gains can continue to be deferred. The postponement is achieved by deducting the gain made on the old asset from the cost of the new one. So we're rolling over the gain on the disposal of the old asset against the base cost of the new asset. What are we doing, therefore? We are reducing the cost of the new asset. By reducing that cost, when it subsequently is sold, the gain will be that much bigger. And it is at that point that the gain would crystallize, unless, of course, having sold again, you buy again. Keep on reinvesting all the proceeds, you keep on being able to defer all the gains. But where the disposal proceeds of the old asset are not fully reinvested, the surplus that retained reduces the amount of capital gain that can be rolled over. So to the extent that you have failed to reinvest the proceeds, that amount of any gain arising will remain chargeable now on the company. As we said, in calculating the gain eligible for the rollover, again, the indexation allowance is the only new element bringing in. Same rules as ever as regards when must the replacement occur, the same window of opportunity running from 12 months before to 3 years after the disposal date. A 4-year window of opportunity there, from a year before, 12 months before, to 3 years after, 36 months after the disposal of the old asset. Plenty of time, therefore, in which to make the reinvestment, and then again, plenty of time in which for you to make up your mind about whether claiming rollover relief. 4 years from the end of the accounting period in which the disposal occurred. So plenty of time for decisions to be made and for the reinvestment to occur. Right, let's see how it works, therefore, with example 1. Calculate the chargeable gain and the base cost of the new asset for here. Right, JM Limited bought a building for use in the business, October 94, RPI 145.2, cost £150,000. Sold in October 16 for £400,000 when our RPI was 264.8. In December 16, JM bought some land for use in the business for £500,000. JM as a 31st of December year end. Right, calculate the chargeable gain and the base cost of the new asset. Ever so easy. The gain. JM Limited sold the building for £400,000. Sales proceeds, £400,000. What was the cost? Cost, £150,000. The unindexed gain, therefore, £250,000. That's the unindexed gain. Now, whereas for an individual, that was it, that is the figure that you would then seek to claim rollover relief in respect of. All we've got to do now is to deduct our indexation allowance. Now, for that, you need an indexation factor. How do we deal with that? Right, what is the RPI now for the month of disposal? 264.8. Pardon me. Minus, what was the RPI when we bought back in October 94? 145.2. And we use that to establish our indexation factor. So that would be 264.8 minus 145.2 all over 145.2. Take that to a 3 decimal place indexation factor. So put it through your calculator. Again, pardon me. Hopefully, That to the nearest third decimal place equals 0. I got for that one 824. Multiplied by your allowable cost, that's your 150,000. And that, again, do check on your calculators and make sure I haven't made a silly mistake or haven't updated it properly in the notes. But I got that to be £123,600. Take it away, and that leaves me with a chargeable gain of £126,400. So at that point of disposal, on that property sold that had been used in the trade, we're looking at a chargeable gain of £126,400. But what has happened? We bought another one. Well, another qualifying business asset. Here it happens to be land for use within the business. Now then, the rules. Have we acquired the qualifying business asset within the relevant time scale? The sale was October 16, the purchase December 16. Is that, of course, between 12 months before to 3 years after the disposal date? Yes, it is. It's only a few months after the disposal date. So the reinvestment has occurred within the relevant time scale. Again, if working a written question, you make these points. If it's an objective testing question, there is just the numbers to be computed there. On a written question, though, we make the point that the reinvestment has occurred within that relevant time scale. Next question, is it full or is it partial rollover? It's full rollover because we've reinvested all the proceeds. Sold for 400,000, bought for £500,000. Therefore, less, let me just abbreviate, our rollover relief. So the full 126,400 will be deferred if the claim for rollover relief is made, meaning that the entire gain will be deferred there. So the entire gain will be deferred. Very good news indeed so far as the company is concerned. What do we then do? The effect of that rollover is to reduce the base cost of the newly acquired asset. So the base cost of the land, it would have been 500,000, the actual cost, minus the rollover relief, minus 126,400. And that will therefore give us a lower, a deem cost of 373,600 pounds. So as and when in the future the land is disposed of, instead of using its actual cost of 500, that means we will then use the deem cost of 373,600 pounds. Exactly the same logic as that which we used when dealing with individuals. It is just that now we've got a situation where we had to use indexation allowance. But that does make an important difference as well in the context of the impact of rollover relief. When the land is sold in the future, as we've just kept repeating, hence the incessant underlining, 373,600 will be used as the cost. So when that cost goes through in calculating the gain on the disposal of the land, then it is on that figure that the future indexation allowance will be based. So you will only get, the company here, JM Limited, will only get in the future, on the sale of that land, indexation based on the allowable cost of 373,600 and not the actual cost of 500,000. So the effect of the rollover relief in reducing that base cost to the revised 373,600 is on its future disposal, then in fact the gain arising will be bigger not just as a result of a lower cost, but also of a lower indexation allowance figure as well. Now that may not be a problem, because again, as we have said, when that land is sold in the future, if all of its proceeds are again reinvested in another qualifying business asset, then all of that gain, bigger though it may be than would otherwise have been the case without rollover, but all of that gain will again be deferred. If you keep reinvesting all the proceeds, you keep on deferring. So those gains, pardon me again, whether bigger or not, are never actually going to crystallize as long as you keep reinvesting. But if you take out any money on the deal, it is at that point that, of course, the gain will crystallize. So understand here that because of indexation allowance, that base cost on the future disposal of the land, it being lower, means a lower indexation allowance as well. Okay. Moving on. What we've seen there is, of course, reinvestment of all of the proceeds. What happens now in this example too? Again, we bought land for use within the business. We've got the date, we've got the RPI, we've got the cost. Sold in October 16, we've got the date, we've got the RPI, we've got the proceeds. We then see that in September 16, so sale in October 16, purchase in September 16, yes, that is within the 12 months prior to the disposal date, so rollover is possible. We bought a factory for use in the business, but for £335,000. Sold for £350,000, bought for £335,000. It means that we failed to reinvest all of those proceeds, so on that basis, therefore, only partial rollover will be available to us. But again, a very simple set of calculations for us to perform. Right. Calculate the gain and the base cost of the new asset. Sales proceeds. The land was sold for £350,000. What was the cost? The cost, as we know, there, £200,000. The gain, therefore, £150,000. Unindexed, I don't want to underline that. Unindexed gain, £150,000, less indexation allowance. Now, you shouldn't need me to show you how to do the indexation allowance calculation. You've got the RPI now at the month of disposal, 264.8. You've got the RPI when you bought, 181.5. Work out your indexation factor and apply to your allowable cost of £200,000. So I'll give you a moment, therefore, just to put those numbers through your calculator. And hopefully, as you put them through your calculator, you will therefore be able to determine an indexation factor of what I hope anyway, but do check it through, 0.459 times £200,000, the allowable cost, and that should be an indexation allowance of £91,800. Take it away, and that leaves us with a chargeable gain prior to any rollover relief claim being made of £58,200. Assuming, as we would, the company will indeed make a rollover claim, we've already determined that the rollover relief is going to be only partial rollover because we failed to reinvest all of the proceeds. So there will still be some of the gain chargeable. Now again, it's very easy when dealing with your partial rollover. What you do is you calculate the amount of the gain of £58,200 that remains chargeable. And that's very easy because it arises because you failed to reinvest all of the proceeds. So what did we sell for? Again there, underlining dramatically, £350,000. And how much of those proceeds have we reinvested? The purchase cost, £335,000. So how much of those proceeds have you taken out on this deal? That is obviously £15,000. So £15,000 of the £58,200 gain arising will remain chargeable at this point as a result of this partial rollover relief claim. The rollover relief is itself just a balancing figure. Out of £58,200, we remain chargeable on 15. Therefore, the rollover relief will be restricted to a balance of £43,200. Simply the difference between what the gain was that actually arose and the amount that will now remain chargeable. Rollover relief, £43,200. What do we do with that rollover relief? Your base cost of your new asset, the property, the factory there, was $335. So your dealing cost will be actual cost $335 minus the rollover relief $43,200. Take it away, and we will have, what's that going to be? £291,800. £291,800. Again, at the future disposal of that factory, you will know that is the allowable cost to use, and that is the cost upon which you will then also base your indexation allowance. That is the reduced cost after rollover relief has applied. Another point to remember, that if you're dealing with a written question anyway, at this point you have failed to reinvest all of the proceeds, therefore $15,000 of this gain remained chargeable. But the window of opportunity for rollover relief extends for 3 years after the disposal date. It was sold in October 2016. Therefore, another 3 years would take you through to October 2019. So if prior to October 2019 you were to make further reinvestments in other qualifying business assets amounting to £15,000 or more, then a further claim or claims for rollover relief would be available to you. That gain at the moment that is chargeable could still be deferred in the future. Now, if it was 2 years from now where the reinvestment occurred, then fine. 2 years is within 3 years of the disposal date. You therefore make the claim when you reinvest that further £15,000 plus to defer this gain. What you'll be thinking is, but I've already paid the tax on that gain in relation to this accounting year, the year end in which the disposal occurred. Yeah, so if you have already paid the tax, and we now discover that this further £15,000 here can be deferred, on that £15,000 you would have been charged a corporate tax at 20%. That would be £3,000. So a subsequent rollover relief claim to further remove that £15,000 gain would result in a corporate tax repayment at that future point in time amounting to £3,000. So the fact that this £15,000 is included in this accounting period corporate tax comp rather than the original $58,200, just the £15,000 after this rollover relief claim has been made. If that is charged to tax, 20% tax, £3,000 of tax on that gain within your overall taxable total profit of the company for the accounting period. If having paid that tax, presumably 9 months and 1 day after the end of the accounting period, if having paid that tax, we then go on to make a further purchase, then you'll get that tax back as a result of that further rollover relief claim. So we have got both full rollover and partial rollover, and again I'll repeat, the only difference here is that we're having to compute indexation allowance in computing the gain, but the principles are exactly the same. Back to our notes. We mentioned about depreciating assets, and that therefore we'd have a slightly different rule when it came to dealing with them. First of all, what is a depreciating asset? As I mentioned to you before, with an expected life of a maximum 60 years, no more than 60 years. And for that purpose, we always take fixed plant and machinery as being such a depreciating asset. The only other one that you'd have to see, again, same note as we had when looking at individuals for CGT, you've only got to know about fixed plant and machinery, and then a leasehold property with a life of 60 years or less. So if you, again, it's usually properties that we deal with, if you sell a freehold property and buy another freehold property, therefore we're talking about rollover relief. If you sell a freehold property and buy a leasehold of more than 60 years, you are again talking about rollover relief. But if the property you buy is a leasehold property of no more than 60 years, so like a 55, a 45, whatever they're less than 60-year lease, then, although a deferral is available, it works in a different way to that of rollover. Rollover, remember, reduced the base cost of the newly acquired asset. In properties, they reduced the base cost of what would usually be a freehold property. But if the investment is now in a depreciating asset, again, as we said, the gain is deferred, but it is not deducted from the base cost of the new asset. Instead, it is deferred, awaiting the earlier of. Now, what event in the future would logically cause this, the deferred gain, to crystallize? And that, of course, would be the disposal of that asset, whether it's the fixed plant and machinery or the short lease that has been disposed of. Again, the deferral is only available because you use the asset in the trade. It's got to be an asset used in the trade. But you will defer until the date the new asset ceases to be used in the trade. Again, typically with a property, you buy it for use within the trade, then for whatever reason, maybe the production goes down as a result of a problem in the economy, and what you do is you rent out that property rather than using it in the trade because it's now surplus to your own production needs. That, therefore, is a non-trading use. That's an investment rather than a trading use of the asset. That would cause the gain deferred to crystallize. Or if neither of those two events has occurred before 10 years after the new asset was acquired. So not based on the disposal date, the acquisition date. 10 years after the new asset was acquired. So here in example 3, we've got the company buys land for use in the business. There's the date, there's the RPI, there's the cost. Sold, there's the proceeds, there's the date, there's the RPI, allowing us therefore to compute the chargeable gain on that disposal. Then, having sold in May 2009, there is a purchase in March 2011, where it is this time fixed plant for use in the business that has been bought, costing, and there's the cost of that new fixed plant, £390,000. What then subsequently happened? Sold the plant in February 17. YR Limited, I should say, has a 31st of March year end. So the original sale, May 2009, that's in the year ended 31st of March 2010. The subsequent sale of the plant, the fixed plant and machinery, February 2017, that's in the year ended March 17. Hence, for us to compute the gains for those two accounting periods. So firstly, for the year ended March 10, we had sales proceeds, the land was sold for £350. Cost, the cost, £200,000. Take it away, we have a gain of £150,000. You can then compute that indexation allowance thereon, RPI the month of disposal, RPI for the month of acquisition. So if you would do that now, please, establish that indexation allowance, we'll deduct it, and then derive, at that point, the chargeable gain. Our indexation factor, which hopefully you're working at the moment, date of disposal, RPI 212.8, minus at acquisition 156.3, or over at acquisition 156.3, expressed to a 3 decimal place indexation factor there, and that hopefully will give you, but again check, store this if you need to at this point in time, but I got that to 0.361 times what was the allowable cost, £200,000, and therefore that will give you 72,200, all being well, as our indexation allowance, take it away from the 150 unindexed gain, and we've got a gain, chargeable gain for the company, this period of £77,800. Now at that point, what claim would have been available to us? We've sold a qualifying business asset, land acquired for use within the business. We've sold it in May 2009. We have then bought another qualifying asset, here though a depreciating asset, our fixed plant and machinery, and that was bought in March 2011. Have we bought within 3 years of the disposal date? Yes, we have. May 2009 the disposal, March 2011 the acquisition. Therefore, a rollover relief claim is available. Is it full? Is it partial? What did we sell for? £350,000. What did we buy for? Just about to see hidden in there, £390,000. We have therefore reinvested all of the proceeds. Therefore, as all of the proceeds have been reinvested in another qualifying business asset within the 3 years following the disposal date, that therefore means that a claim for deferral will be available to you. Now again, that deferral, given the fact that it's a depreciating asset that has been purchased, will not impact on the base cost of that fixed plant and machinery. That will stay at £390,000. What then will happen on the subsequent disposal in February 2017? Well, in addition to any separate gain computed on the disposal of the fixed plant itself, what we will have is also a crystallization of the deferred gain. Look at what has happened. We have an acquisition date of March 2011. This deferred gain of £77,800 will crystallize on the earlier of 10 years. Is it as yet 10 years from March 2011? No, that would be March 2021. Or the cessation of the trading use of the asset. We haven't had that. What we do have in February 17, so within the 10 years following the acquisition date, is a disposal. And therefore at that point, as a result of the disposal, in February 17, for that year ended March 17, we will therefore crystallise that earlier deferred gain of £77,800. So in addition, in the year ended March 17, to dealing with the separate disposal of the fixed plant and machinery itself, what we must also do is to crystallise this deferred gain. Now that said, that deferred gain may also be eligible for continued deferral if what had happened was this. When the replacement asset is a depreciating asset, yes, it is a depreciating asset, fixed plant, the gain is deferred to, as we've just said, the earlier of those three events. But if a non-depreciating asset had been purchased before the deferred gain crystallises, then your original gain, that was your £77,800 there, the original gain that was only held over, deferred until the earlier of those events, may now be rolled over against the cost of the new non-depreciating asset. That would mean that it would only then crystallise on the sale of that new non-depreciating asset. A typical example, you sell a freehold property and you make a chargeable gain. You then initially reinvest in, say, a 55-year leasehold property. That is less than 60 years, not more than 60 years, and on that basis, deferral is available, but not by rollover, by means of this holdover, as we may refer to it as, deferring it until the earlier of those three events. Well, if prior to the sale and prior to the 10-year period running out, there is the purchase of another freehold property, again, with a full reinvestment of effectively all those original proceeds of £350,000. Then, if that happens, what had been only held over could now be rolled over, and that therefore would mean that we reduce the base cost of the newly acquired freehold property. Now, as I say, probably not likely in the context of a number example for you, but if you're dealing with a written question involving these gains, and this were to happen, if you had the acquisition of, again, a depreciating asset, you could always add in your written answer to the effect that the currently deferred gain, deferred until a maximum of 10 years following the acquisition date, that could potentially be rolled over if before the gain crystallises there's a further reinvestment in a non-depreciating asset. Okay, lots of work for you now to get on with, in as much as we've got these technical articles for you to read through on chargeable gains, both parts therefore. That will contain a lot of illustrations from past examination questions, and as absolutely as all the technical articles are, and absolutely vital, not just read, but work through. Don't just read it, work it. There are examples, you work them through. Don't just read the question and read the answer, you work the answer for yourself. Once done, then practice question 28 for you to have a go